chat quickly about treasury stock. Treasury stock is when a corporation buys back its own shares. So remember, in the sole proprietorship, we just had one owner's equity account called owner's capital. Now that we're in a corporation, we still have a section called owner's equity, except now we call it stockholders, shareholders equity. And it's just got more categories. And the last one listed here is treasury stock. That's stock that we've bought back. And why would we buy back shares? Well, there's lots of reasons. We might have some excess cash laying around and we could declare a dividend, but if we do that, that cash that we deliver to our shareholders will be taxed at ordinary income rates. Capital gains taxes, so when we buy back their shares, any money that they make on that repurchased by us would be taxed at capital gains rates. That's going to traditionally be a lower rate. Some of this tax efficiency was lost recently when the Congress decided that qualifying dividends, in other words, if we've held the stock long enough, we get to pay a lower tax rate than if there were non-qualifying dividends. But whether it's tax efficient or not, buying back shares is another way to put cash into the hands of our shareholders. Another reason might be to increase earnings per share and return on equity. Earnings per share is net income minus preferred dividends divided by weighted average number of shares outstanding. So if your company made $1 million in net income and had no preferred dividends and there were 100,000 shares outstanding, $1 million divided by 100,000 would mean that the earnings per share were $10. But what if your company bought back half those shares? So then it would be $1 million worth of net income divided by 50,000 shares, or $20 per share. So your earnings per share would look that much stronger. And if you decrease the equity, remember that that treasury stock is a contra equity account, so it's going to have a debit balance. It's going to decrease our equity so that our return on that equity is going to look better. When we decrease the denominator in a fraction, it's going to make that return look that much better. Another reason might be that we're going to need stock to give to our officers. So we'll give them stock option plans that gives them the right to buy our shares at a certain set amount. That encourages them to make the stock price go up so they can buy them under their option for a lower price and then sell them for the higher market price at the time. We'll need shares to give to our employees to make those stock options work. Maybe we've got a hostile shareholder, a really difficult shareholder. Maybe we buy back his or her shares or the corporation shares. Or maybe we want to thwart a takeover attempt. So if we can buy back our shares, it'll drive up the price of our shares. It'll make it that much harder for somebody to buy up controlling interest in our company. And finally, we might want to make a market in our stock. So if we start buying our shares, what's going to happen is the rest of the stock market is going to think, hey, nobody knows them better than themselves. They must think that stock is priced too low. We should also buy it. And so if we get more people buying our shares, that should drive the price of the stock up. So there's two ways to account for treasury stock. One is the cost method, the other is the par value method. All we're going to talk about is the cost method. We simply put it on our books for what we paid for it. So let's assume that we buy back 4,000 shares of treasury stock at $8 a share. What's happening to cash, up or down? Cash is going down, so we're going to be crediting cash for $32,000. And like I say, in the cost method, we simply put those shares on our books at their cost. The tricky part is if we sell them for more than what we paid for them, we won't book a gain because we don't want to be in the business of buying and selling our own shares. GAAP doesn't want us manipulating the stock price just so we can make money on our treasury stock. So now let's pretend it's 6 months later and we sell 1,000 of these shares, but we sell them at $10 a share. So we originally bought them at 8 and now we're going to sell them at 10. And we don't want to book a gain on our income statement because, again, GAAP doesn't want us to be in the business of buying and selling our own shares. We're in the business of the restaurant business or the grocery business or the wholesale club business or the computer business. We're not supposed to be in the business of buying and selling our own shares. So we sell 1,000 shares for $10 a share. That means we get $10,000 cash. those shares were on our books for $8 a share. 8 times 1,000 is 8,000. So we take those shares off our books with a credit of 8,000, and the extra 2,000, instead of being a gain on sale, goes into this odd account called paid in capital from treasury stock. So it's part of our equity section. So in fact, our equity does increase, but it doesn't go through the income statement first. And note that it doesn't say additional paid in capital, it's paid in capital from treasury stock. So now let's assume another 3 months goes by and we sell 800 more shares of our treasury stock, but this time at less than what we paid for them. So we paid $8 a share, and let's say we sell these 800 shares at $7 a share. So that's $1 a share loss. But again, we don't book gains or losses on the sale of treasury stock. What we'll do is we'll use up a part of this paid in capital, this increase in equity that we booked before, to book the loss, quote unquote loss, on the sale of that treasury stock. So we sold 800 shares at $7 a share. That's $5,600. That means cash gets debited for $5,600. Those 800 shares were on our books at $8 a share. 8 times 800 is $6,400. So to make that journal entry balance, we have a debit of $800. And like I say, we use up part of this increase in equity that we booked by reducing it by $800. If there were a zero balance in here, or if we used up all that paid in capital from treasury stock, we would debit retained earnings. So we would decrease our equity, but again, it would not flow through the income statement.